This is Inga Windsor at the Local Market Monitor. Our market reports are available for 320 local markets and are useful both for investment decisions and risk management. They help figure out if economic conditions in these markets are favorable for investments directly in existing businesses, properties, or new construction, or indirectly in business loans, real estate financing, or mortgages. And they give warning when deteriorating conditions will increase the risk of these investments and decrease the value of loan portfolios. A typical market report looks like this. There are 5 pages in all. On the left, you see charts of data. On the right, you see commentary. In addition to the actual data, some charts also show our 3-year forecasts. All the raw data are from public government sources. You can get them yourself if you want to. Our main job is to show you what the numbers mean. Here's the second page, the third page, fourth page, the fifth page, just so you can see what you're getting into. And now let's go back to page 1 and discuss some of the individual features. The commentary at the top summarizes the current conditions. The first paragraph is about the local economy in general. The second is more specific to real estate. The investment score and local investment rating are the overall summary of the balance between opportunity and risk in a market. The score is a formula that considers population and job growth, unemployment, home prices, our price forecast, and right now, several factors specific to the COVID recession. The score and ratings don't mean a market is good or bad, just how much risk an investor should expect. The first chart shows how home prices have changed and our forecast. The behavior of home prices shows the strength of demand for local housing, owner and rental. It's the first thing you should look at in any market. I want to take a little extra time with this. When home prices rise at less than about 3% a year, demand for all types of housing is weak. On the other hand, if the rise is more than 7% or so, demand is probably too strong and a price bubble will follow. A bubble isn't necessarily bad, especially if you're flipping properties or rehabbing them for resale. Bubbles can last years. But you need to know when the peak is near, and that usually happens when price increases get smaller and smaller. A bubble is bad for investors in rental property because once the bubble is over, they have a hard time finding tenants who can pay the high rents they need. Just beside that chart, for those markets that include several counties, is our home price forecast for each county. These will usually be similar because the counties are in the same economic area, but in any market, some areas are always more popular than others. The next chart shows a comparison of actual home prices with a calculated value we call the equilibrium home price, which can also be thought of as the income price, the price that matches average local income. In this example, look back in the early 2000s, way on the left of the chart, when prices rose much higher than the equilibrium price, only to fall back. This is the value of the equilibrium home price. It tells us when a market is in an unsustainable boom, when home prices will fall and the risk for investors is climbing. How can you spot a bubble like this? If the actual average price exceeds the equilibrium price by 20%, you should start worrying. And I would get very nervous at 30%. One other point. In this market, after the 2008 recession, prices fell back to the equilibrium price and then began to rise again. But in some other markets, prices went well below the equilibrium level and entered a long period of price stagnation. When home prices are much below the equilibrium price, demand for housing is very weak. The next chart on page 2 of the report shows the rate of job growth, which is the best measure of how well the local economy is doing. In this example, we see the depth of the 2008 recession and then the big drop in 2020. By tracking job growth, we can anticipate economic slowdowns. Look closely at this chart, and we can see the rate of growth already slowing in 2006 and 2007. This was well before the real estate market crashed. Every monthly twitch in job growth isn't important, but major trends are easy to spot. Aside from trends, in a healthy local economy, jobs are created at a rate of at least 1.5% a year. And in rapidly growing markets, you can see jobs growing at a 3% rate. The next charts show owner and renter occupied housing and our forecast. Looking closely, there are twice as many owner occupied units as there are rental units in this market. Note also the rapid increase in rentals before and during the 2008 recession when home prices were very high. On page 3 of the report, the first chart shows the risk-adjusted cap rate, a calculated value of the amount of risk an investor is taking in this market. In this example, you can see the high risk before 2008. Ordinary cap rates show the actual return investors receive on rental properties. The risk-adjusted cap rates show the return an investor must get to make up for the higher risk. The next chart shows the growth of the population. In this example, the high population increase in the early 2000s was one reason home prices ended up in a boom. A lot of demand for a limited resource. The situation today is quite different, with growth well below the national average. The next chart shows the annual increase or decrease in both home prices and rents and our forecasts. In this example, we can see that rents normally don't rise as fast as home prices and that they almost never come down. The first chart on the next page shows actual average rents by quarter and our forecast. Average rents usually run right in line with average income. The next chart shows monthly levels of new housing permits. Note that permits don't always turn into actual construction, especially when prices are booming. The next chart shows quarterly vacancy rates for rental and owner properties. The higher rates for rentals reflect the fact that most renters move within 2 years. On the last page of the report, the table at the top shows the structure of the local job market, how that compares to the US average, and at what rate jobs in each sector are growing or shrinking. In this example, the government sector is much larger than average, and government jobs actually increased during the past year, even with the pandemic. The next chart shows monthly unemployment, which in this case was steadily decreasing before the pandemic hit. And finally, the last chart of the market report shows the accuracy of our home price forecasts. These were actual forecasts made at that time. They're not back calculated. You can see that our forecast lags behind at major turning points, but not by much. And most importantly, it's never off by much. That's because our forecast formula always looks first at the most recent actual price data and then modulates it with our expectations of future economic growth. It's a very simple approach that has worked extremely well over the years. So that's it. Thanks for following along. If you have questions about any of this, please let us know. We really value your comments. You can reach us anytime through info@localmarketmonitor.com. We're happy to help, and we need your comments to improve our reports. Have a very safe and profitable year. I'm Ingo Windsor.